U.S. tax traps for expats. This is for anyone who's leaving the country, the U.S., whether you are a U.S. citizen or a long-term resident in the U.S. moving on, or green card holder leaving the country, or someone who has decided to relinquish their status. So the simple and painful truth is that the IRS follows U.S. taxpayers globally. In my practice, unfortunately, I have seen far too many times that many expats believe that simply leaving the U.S. cuts the tax cord with the IRS. This is not true, and such oversight can lead to the devastatingly costly penalties and painful process of cleanup down the road. So the question is, you left the U.S., but did the IRS leave you? In this video, let's find out why crossing the border doesn't mean that you can cross the IRS off your. Hi, my name is Jennifer Lee. I'm a cross-border tax and estate planning attorney in the U.S., and it is at the core of my practice to help out people with lives and assets spanning international borders. Start with a fundamental rule. The single most important rule in the U.S. tax code is that the taxation is based on who you are, not where you live. So if you're a U.S. person, you're subject to U.S. tax on your worldwide income, no matter where you live, no matter where on earth you earn it. So every U.S. person is subject to U.S. tax. A U.S. person is a legal term that is in the U.S. tax code. So what makes someone a U.S. person? It mostly commonly boils down to three categories. Number one is U.S. citizen. If you're a U.S. citizen, you are automatically a U.S. person. Number two is if you're a green card holder. So if you receive the green card, which means that you have the rights to legally reside in the U.S. Permanently, that makes you a U.S. person. And number three rule is based on what is called the substantial presence test. So let's take a look at what is a substantial presence test. So the substantial presence test is not about your visa or immigration status. In fact, it has nothing to do with immigration status. It is a pure numbers game according to the U.S. tax code formula. So under this test, if you're in the U.S. for 31 days this year, you trigger the first part. Then the tax code uses a weighted formula for the preceding 2 years, counting all of this year's days in the U.S., plus 1/3 of last year's U.S. days, plus 1/6 of the year before's, to see if this person hits 183 days. So here I have a little real-life example. This person was in the U.S. for 150 days in 2025, this year, the current tax year, and then that's well over 31 days, right? So the first part of the test is met. Now, for the first preceding year, we get 1/3 of the 180 days she was in the U.S. Then, for the second preceding year, we get 1/6 of the 30 days she was in the U.S. Add it all up, it's 215 days. She has met the substantial presence test and is a U.S. person. So here, please note that she was only physically in the U.S. for 150 days this year. That's not even half a year, right? But the weighted U.S. state formula determined that she was a U.S. tax resident. This is the long arm of the U.S. in action. So if you're a U.S. person, your U.S. person status and filing requirements do not automatically end when you're paying tax off to leave the U.S. So understanding this rule is a critical first step before everything else, like filing requirements and exit tax that we're going to talk about later on, because they all stem from this foundational principle. Your second trap is failing to file what is required of you as a U.S. person. And on this slide, I listed some of the most common forms that I encounter among my expat clients. But in general, to really simply speaking, this is generally not one single simple 1040 filing It's because the U.S. government also wants to collect information when you're a U.S. expat. So knowing the required compliance is very important because, um, as I'm going to touch base a little bit later, there hefty penalties of non-compliance per form, and so that is the immediate exposure that you have for filing these forms. Also, the something like Form 5471 or 8865 that comes into play when you have a business ownership in a foreign corporation or foreign partnership, and that complexity is really not a DIY type compliance item. So there will be a tax cost that is required of you in entering that type of transaction. So evaluate these requirements before you jump into transactions and establish your business entity or investment ventures in a foreign country. But more importantly to me, a critical non-monetary penalty here is that if a required information return is not filed, then the statute of limitations for assessing tax on the entire return remains open indefinitely. This means the IRS has a permanent green light to audit that year's tax return basically forever. So it doesn't expire until 3 years after the required information return is filed. So, and I'd like to mention another common mistake I typically see is that in the year of the departure of a non-U.S. citizen who is a U.S. person, doesn't file a proper dual status return in the year of departure. And if you're taxed as a U.S. tax resident for the part of the year and as a non-U.S. tax resident after the departure, then you would have to file the dual status return to properly close out your tax status with the IRS. The split year reporting is a final crucial step for departing non-U.S. citizens to cleanly sever the U.S. tax residency. Number 3, the expatriation trap. Expatriation for U.S. tax purposes isn't just leaving, and it is a formal legal process to sever your tax ties with the U.S. So for the U.S. government, exit is definitely not a one-way street. You can leave the country, you can even relinquish your citizenship, but the U.S. government has a very long memory, especially when it comes to taxes. And essentially, the U.S. government imposes an exit tax if you're a covered expatriate to make sure it collects a final deferred tax bill on the wealth growth taxpayer enjoyed as a U.S. citizen or resident in the U.S. If you're relinquishing U.S. citizenship or ending green card status to permanently live outside the U.S. for the rest of your life, it is really important to file your final Form 1040 along with 8854, what is initial and annual expatriation statement. So for the vast majority of expats, Form 8854 is filed only once to close out their U.S. tax acts, unless the taxpayer is what is known as covered expatriate. And if the taxpayer is a covered expatriate, then that person would have to file it annually until all those deferred tax payments are made, and then really close out all those tax liabilities with the IRS. But no matter what, it is very important to be aware of this Form 8854 to really sever your ties with the IRS. Now, I do want to talk a little bit more about covered expatriate, and on this slide you can see the testing to determine whether someone is a covered expatriate or not. The test is net worth test. If you have a high net worth, that is the net worth 2 million or more, or you had 5-year average income tax liability that was more than a threshold each year, and that number changes every year. And for 2025, the number was 206,000, or you haven't filed a tax return for the past 5 years before your expatriation, then you will be deemed a covered expatriate. And this is important to know that because this triggers a mark-to-market exit tax regime where the IRS treats all your worldwide assets as if it sold them the day before your departure and taxes the unrealized gains. So there is a mechanism where they try to collect these taxes over time, and that's where the deferred tax payment comes from. And you will have to file this 8854 annually until all the tax payments are paid. And another point I'd like to bring up here is expatriation taxes versus deportation. And unfortunately, nowadays we do see a little more cases, unfortunate cases of deportation. And the crucial point here is that being forcefully removed out of the U.S. due to deportation does not automatically protect you from the tax. So the rules are complex, and if you're in this unfortunate case, I advise that you need to consult with a professional to take care of your tax filing status, to determine your tax filing status and address it properly. Now, the fourth and final track is foreign assets and gift and estate tax for U.S. expat. So first thing is that while a U.S. citizen or U.S. person with a tax home in the U.S. has a very high unified gift and estate tax exemption, which is currently $13.99 million for 2025, which is going to go up to $50 million next year in 2026. The non-U.S. resident, non-U.S. citizen will have only $60,000 exemption amount. So any transfers above that minimal threshold can be actually taxed up to 40% tax rate under the current U.S. gift and estate tax regime. So in doing the estate planning with for U.S. citrus assets of a non-U.S. citizen, non-U.S. resident, it is also important to remember the U.S. citrus assets are defined a little bit differently for gift tax versus estate tax. So it is important to potentially list your assets and incorporate what asset is going to be considered U.S. citrus asset for gift versus estate tax purposes, and who's going to receive those assets. And another thing that can come into play very often between married couple is that if your spouse is a non-U.S. citizen, you don't have an unlimited marital deduction. So there's a dollar limitation every year. That number changes every year, and for 2025, it's 190,000. So it can be a significant dollar amount in many cases, but sometimes I see that between married couples, the gifting is actually kind of blurred. So that happens when they purchase something together under joint tenancy, like under both of their names, and unexpectedly one spouse is gifting over that dollar amount to a non-U.S. citizen spouse, then there's going to be a consequence on gift tax limitation because of much lower, which is actually not limited, not an unlimited marital deduction between a U.S. spouse and the non-U.S. citizen spouse. And the very last item that I want to make sure to talk about is there is a new enforcement mechanism that the IRS is going to implement through new form 708, that is 40% flat tax on inheritance from a covered expatriate that we already talked about. And so essentially, if there's an inheritance from a covered expatriate and that inheritance is received by a U.S. person, U.S. beneficiary, then there will be a 40% flat rate tax. This is pretty much of a draconian tax, but the IRS had the project going up for a while, and they released the final regulations earlier this year, and we are expecting to see the implementation of the enforcement system through the form. So estate planning, when you're covered expatriate, or before you make that decision to expatriate, is extremely important to go over to prevent anyone from suffering from unexpected tax consequences from inheritance or passing of the assets. And also, the trend now is that I see more trust development in the countries where they didn't traditionally had a trust available. And when the U.S. person or a covered expatriate enters into this type of trust transactions, make sure this the trust transaction does not cause unintended tax consequences. So one thing that the U.S. beneficiary would have to file is Form 3520A, and that form is, again, that is not one of those DIY forms. There's also a required statement that needs to be filed with that, and there's also a complex calculation if the foreign trust had distributions, which is also known as throwback tax. But all of these things are a little bit complex. So before you think about setting up a trust in a foreign country, you need to analyze the tax consequences of the distributions for your U.S. beneficiaries and see if what the best way to mitigate the tax results. And also, if there's a gift or inheritance coming from a non-resident, non-citizen person to a U.S. taxpayer, U.S. person, then there's of course, Form 3520 needs to be filed. So to recap, do not fall into the traps of informal expatriation, hidden filing or non-filing of required returns like FBAR and FECA, and ignoring the U.S. tax implications on your foreign assets in the state. Be proactive, and if you really need, get professional advice and secure your financial future. And my advice to you, if you are not ready or everything is too overwhelming, please consider making things simple. That is not a bad strategy when it comes to U.S. tax planning. So thank you for watching, and this video is for educational purposes only, as always, and does not constitute legal or tax advice. Consult with a qualified professional about your specific situations. Thank you.